Do managers of a company have an economic incentive to lie? Of course they do. They have an economic incentive to make the financial position of the company look better than it actually is. There are lots of reasons for that. Their economic life and future is tied to the prospects of this company. So of course they've got an incentive to lie. So how can we as outsiders believe a company's reported financial statements? I mean, how can we? But also remember this. Do good companies have an incentive to convince outsiders like you and me that their financial reports are actually truthful? Yeah. So we've got bad companies, companies that are shaky a little bit, have an incentive to lie, but good companies have an incentive to somehow try to signal to the rest of us, we outsiders, hey, we're great, we're fine. So that's the status of things. There's an incentive to lie, but there's also an incentive to tell the truth. Internal and external auditors help us as users of financial statements have more comfort with believing the financial statements, and they also help companies to be able to report truthfully. Good companies can report truthfully. There are internal auditors. Good companies have an incentive to have a staff of auditors inside the company to make sure, hey, we're cleaning up our own house here. We're making sure that our financial reports look good. And we've got independent checks on our people to make sure that nobody is exercising excess earnings management, not on our watch. There are also external auditors hired to come from outside a company to give so that we outsiders outside the company can believe those financial reports. And those external auditors have huge incentives to do a good job, as we'll see in a bit. Internal auditors, we're going to clean up our own house. External auditors, we're going to have somebody come from the outside and check and make sure we're okay, so that the outsiders, the users of the financial reports, can believe what they read. Internal auditors are full-time employees of the company itself. So they're not the accountants who are doing the day-to-day accountants, but they're an independent group working for the same company, but they come around and they do independent checks. What are their duties? Well, they independently check the accounting reporting process. Are our colleagues who work for the same company, are they doing their jobs correctly? Now, of course, people who are doing their jobs don't like to have the internal auditors come and look over their shoulders, but it's in the best interest of everyone to have this system in place to make sure that a company cleans up its own house. The last thing you want is some kind of accounting scandal to burst forth on the world and realize, oh, we could have found that ourselves and avoided all the embarrassment and loss of reputation. Internal auditors also confirm the existence of the internal controls. Part of Sarbanes-Oxley, our old friend SOX, is that a company and the management of a company has to be able to certify, yeah, we've got a good internal control system. Well, the internal auditors, since they're inside the company, are very well placed to say, yeah, these internal controls are in place and they're working. Internal auditors also report to top management and to the audit committee of the board of directors. It's important that the internal auditors can report to both, because top management, they're running the company on a day-to-day basis. They need to know what's going on. The internal auditors need to be able to talk with them. But let's say that top management, because of huge economic pressures, are pressuring their accountants to bias the numbers, to report numbers that maybe are a little bit too high. Then the internal auditors have to have a channel to report that around top management and go right to the board of directors, the audit committee of the board of directors, which is composed of outside directors. Internal auditors can communicate with both top management and the independent audit committee of the board of directors. The existence of the internal auditors looms in the background. It constrains what managers and accountants can do within a company, because they know, if we do too much here, if we go overboard with our earnings management, quote unquote, at some point the internal auditors are going to find us. So just their existence looms over everything and keeps people maybe a bit more well-behaved than they otherwise would have been.